Ladies and gents, good morning. Good to see you again at ZEFE today's opening, an edition in which I'll be discussing with Althea Spinozzi from Saxo Bank, senior fixed income strategist at Saxo Bank. Althea, good morning. Thank you for joining us.
Thank you very much, TB, for having me here.
Althea, you joined Saxo Bank in 2017 and serve as Teams fixed income strategist. Now you're specialized in fixed income. First of all, for those who doesn't know much about fixed assets and securities, what are you focused on at Saxo Bank? What is your everyday job, to say so?
Well, my everyday job is monitoring the bond cash market, anything that range from sovereigns to corporate bonds, emerging market debts. And really what I try to do is trying to find value within this space, understanding where opportunities and risk lays so that I can provide a better outlook on how to position investment to take advantage of the current macroeconomic backdrop.
Okay, you recently wrote an article with the title "Geopolitical Tensions Fail to Stall the Rise in Long-Term Rates." Please explain what is the impact of the conflict between Israel and Gaza? What did you notice?
Well, what happens here, TB, is that from one day to the other, the market realizes that things can change fairly quickly. So everybody was looking at inflation. Inflation is adjusting lower on both sides of the Atlantic. And then all of a sudden, we wake up on a Saturday morning and it's war in the Middle East. And that has quite a lot of implication. The week after the Israel-Hamas started, the bond market tried to rally. Investors bought long-term yields because there was some sort of safe haven demand. And the bond market the previous week was heavily short on duration. So as yields were hedging lower, certain margin calls were hit, and the bond investors had to cover those calls by buying long-term treasuries. But really, yields failed to fall sensible levels, and with sensible levels, I'm referring, for example, to the 10-year yields failed to break below 4.5%. And this week, we are seeing yields rising even faster. And the reason for that, TB, is that even though war means that there is need for safe haven out there, a war realistically means bigger fiscal spending, because if the US or Western Europe wants to support Israel, it will need to increase its expenditures. And to do that, they will need to increase their sovereign supply. So US Treasury supply in the US and European sovereign bonds in Europe. And also, we cannot exclude that a war is disruptive. It's disruptive for commodities, and that creates a tail risk for commodity prices to rise more than we would have expected. In Europe, especially, they are very sensitive to winter, natural gas, and whatever can disrupt that kind of supply and demand and dynamic can definitely increase the risk of inflation. So basically, the bond market this week is telling us if there is an escalation of conflicts in the Middle East, bond yields are not going to go lower. They're going to go higher because the risk of inflation it's even greater than it was a week before.
What does this mean for capital markets? You're saying that while war in Middle East escalated, brought a new risk of rising inflation or higher risk or rising inflation.
Yes, exactly. So basically, there is the risk for a higher inflation. And if we look at monetary policies from 1 year and a half until today, they've been very much focused in curbing inflation. So what we can expect really is that if there is a rebound of inflationary pressures, central banks on both sides of the Atlantic might continue to hike rates in order to stop the rise of inflation. But even if they don't hike and they stay where they are for longer, that's the message that we get from the Federal Reserve, higher for longer. That's equally bad. It's equally bad because it's an environment, an interest rate environment that the market didn't see since before the global financial crisis. We have the highest yields since 2007. And realistically, if the Federal Reserve and the ECB stay on hold, it means that long-term yields needs to adjust higher. They have to price above the Fed fund rate and the ECB deposit rate. And that's why in the past few weeks, we had seen a bear steepening of yield curves and not a bull steepening.
What is your outlook at Saxo Bank for global inflation? What do you expect for the end of the year and the beginning of 2024?
Well, we expect inflation to adjust lower, but obviously there is this Israel-Hamas conflict. There is a big question mark on what's going to happen to energy prices. And that really much depends on how many agents get involved into this war, because obviously an Israel-Hamas war is going to be very different from a war that maybe includes United States or even Iran. So we are monitoring very closely what happens in the Middle East, and we are willing to adjust that kind of forecast. But in terms of real money investment, we remain defensive. We want to take the least risk as possible. We want to remain in quality. We want to take the least duration risk, which is the most sensitive to inflation pressures. So we just are saying buy quality, look at government bonds, stay on the short part of the yield curve, US Treasuries 2 to 3 years maturity, European sovereigns in the same tenor, and only when the inflation backdrop becomes clearer, extending those maturities.
Is there any demand for bonds? I know that Fed is no longer buying bonds right now, despite that you wrote that right now the auction size for coupon issuance is comparable to the one during the 2020 COVID pandemic. What is your view on bond market trends across the markets, and where are we now, and where are we heading?
I think that when we talk about the bond market, we have to talk about the yield curve. So whatever happens in the front part of the yield curve is very different from what is going to happen in the long part of the yield curve. The front part of the yield curve is going to be anchored because central banks now they have achieved a sweet spot. They might be reluctant to hike further because they don't want to undermine the economy, but they don't want to cut because there is still this inflation risk that is basically playing on the background. But the long part of the yield curve is very much sensitive to everything that you have just said. And the outlook looks bleak. Looks bleak because there is quantitative tightening. So the Federal Reserve is not buying, is not reinvesting running off maturities from their balance sheet into new US Treasuries. We have much bigger auction sizes at the US Treasury auctions. And also, we cannot forget that we have much less foreign demand. The Japanese investors now, when they hedge their US Treasuries position against FX currency risk, realistically, they are getting a negative return. So they are better to buy JGBs at home rather than buying US Treasuries or European sovereigns. So the market is putting a lot of selling pressure on the long part of the yield curve, and that's why yields are rising. But there is going to be, at a certain point, a sweet spot, TB, in the meaning that last week we had some dreadful US Treasury auctions. The auctions tailed across all tenors, so 2 years, 10 years, and 30 years. They all tailed. Even the 10 years, that is the safe haven amid the conflict. That was quite surprising. But yesterday evening, we had a 20-year US Treasury auction. The 20-year tenor, it's the least liked by market. It was reintroduced in 2020. It's pretty much illiquid and is offering a pickup over the US Treasury yield curve. Yesterday, this tenor priced at 5.25% and received very good demand. So it can only mean two things. Either we achieved that sweet spot and demand is coming back around 5.25% in terms of US Treasury yields, or otherwise the problem stays in the size of the auction, because yesterday the US Treasuries sold $13 billion worth of 20-year US Treasuries bonds versus 20 billion in 30-year US Treasuries and 35 billion of 10-year US Treasuries. So it might be that the only way to get that demand back is to issue less bonds. And we are not going there anytime soon. And we definitely see the 10 years breaking above 5% and probably stabilizing around 5.25%.
Okay, and I guess at this moment, short maturities are more attractive.
Yeah, short maturity, we love the 2-year tenors. We really like them because if you run a risk-return analysis, you will see that it's almost impossible to lose money in the 2 years tenor. If you buy 2-year US Treasuries at 5.25% and yields rise by 100 basis points, you will still record more than 4% in total return. This assuming a holding period of 1 year. You need basically yields to rise by 200 basis points. So the Fed then to signal that is going to bring has to bring interest rates from 5.5 to 7.5, which is quite far-fetched at the moment. And only if yields rise by 200 basis points, you start to record a negative total return, assuming 1 year holding period. So it's almost impossible to lose money there. Obviously, this kind of ratio is worsening as you increase the duration, and the worst risk-return ratio is offered by ultra-long bonds, so 30-year Treasury, 30 years German bonds. And when we look, though, at the 10 years part, it looks quite interesting in the meaning that if we run the same analysis, if we believe that there is a shock of 100 basis points in yield in that tenor, US Treasuries will lose only 2% with a holding period of 1 year. German bonds will lose around 5%. So, you know, like, yes, in 1 year, maybe, if there is a tail event such as inflation, spiking where we don't envision to go right now, and 10-year yields are going to rise by 100 basis points, you will lose 2%, but you will still have the optionality that if something breaks, if there is a crisis, a meltdown in the stock market, that position is going to gain. And if yields drop by 100 basis points, you will have a total return of around 12%.
Okay, so you favor short-term bonds. What about bonds in frontier markets? Because Romania is still a frontier market, does it make them riskier? On the other hand, can we talk about better returns?
So I think when we look at frontier markets, we have to look at bonds for the biggest quality. When you buy a bond, you lock in a yield for that bond until maturity. What does that mean? Is that if you buy Romania at 6%, I'm talking in euro terms, for a maturity of 10 years, and you don't sell it before, you're going to get 6% every year until that bond matures, wherever is going the market, and obviously if Romania is not going to default. Said that, when I look at Romania, I believe that the economic backdrop is extremely resilient. Romania has the highest GDP growth across all Europe. We have, well, you have actually a debt to GDP ratio below 50%, and unemployment is expected to constantly fall for the next 3 years. The situation looks resilient. What might be the problem is the political sphere, because when we look at emerging market or frontier market, what really makes a difference is how their government deals with other governments in the European Union and elsewhere, and how do they look debt and spending in their fiscal policies. And I'm Italian, TB. You definitely know that Italy, the political sphere in Italy, it's quite volatile. But I would be buying Italian BTPs because I know that the government doesn't have any interest in not repaying its debt. It always paid its debt. And when I look at history in Romania, I see a country and governments that really want to be whole. They really want to repay their debt. Let's remember, in the 80s, austerity here, and austerity was due just because Romania wanted to repay its IMF debt before time. So said that, I don't think that Romania brings much risk, and actually can bring an opportunity, and yields are well above 6% in euro terms. And I want to remember that in order to double your capital, you need to secure 10% for 10 years. So we are not very far from that. And you know, like, obviously it's not risk-free when we talk about frontier market, but it might be better than overvalued stocks.
Now, Althea, a more feeling and financial education question. How are fixed income assets viewed in Denmark compared to other asset classes? How attractive are they for population, for example?
Can you repeat the question? I apologize.
Yeah, sure. How attractive are the fixed income assets in Denmark compared to other classes of assets for population, for example?
Yeah, they are quite attractive. We are talking about a country that has a very high rating. The biggest bond space in bond market in Denmark is mortgages, and that's very much supported by the state, and yields have been increasing quite a lot. The only problem with Denmark, it might be the Danish krona, in the meaning that the Danish krona has much less options available in terms of investing if we compare it to the euro and the US dollars. So yes, the Danish kronas is pegged to the euro, but realistically, so the hedge, the cost of hedging is not as great as looking at other currencies. But still, if you want to invest in Danish krona, your universe is going to be somewhat limited compared to euro and US dollars.
Okay. How much of a diversified investors' portfolio should be invested in bonds and fixed income instruments?
Yeah, I'm sure that there has been a lot of talks on portfolio 60-40 and why they don't work and so forth. But I think that right now we are facing one of the biggest turning points in history that we have seen, in the meaning that we are coming from a period where bonds were not attractive, yields were too low, and they also failed to provide any kind of buffer against the bond market. But now they really provide the stock market, but they now provide an alternative to the stock market, because you can secure yields at around 5% when the stock market is overvalued. So, you know, while before I completely understood why people were very much invested in stocks, there was quantitative easing, it was a growth environment, companies were doing well and paying dividends quite regularly. Now we might be facing a downturn. Earnings are starting to be mixed, dividends are not guaranteed, so it's almost impossible to understand what is going to be your real return in the stock market. But when you look at the bond market, you can secure around 5%, and that's a certain return. And still, if there is a downturn, you will have capital appreciation. So it's a win and win alternative. And we believe that at this point, you know, like the greatest part actually of the portfolio should be in bonds, because they also offer, they have a lot of kind of parking property. You can park money there and waiting for much better opportunities. You cannot really park money in the stock market.
Yeah. Okay, as a final question and as a conclusion, what should investors be looking out for in the coming period? Some major points.
So the investors should definitely look out for inflation, where it is going to go. And if there is a rebound of inflation, they should really think about what to do with their cash. They cannot keep cash, they have to invest, because if inflation rebounds, then they will be losing money in real terms. But still, the bond market in the US, it's offering yields that are above the inflation. So you're getting a real rate that is positive. In Europe, we are not yet there, but we are getting there. So it's a way to not get penalized in terms of cash. Then they definitely have to look at monetary policies. What are central banks saying? What they are worried about? If the focus continues to be inflation, then also their portfolio should be focused on inflation. And we didn't talk about other bond products like inflation-linked bonds. They can offer a buffer against inflation. Real yields are the highest they've been since 2007. And still, these securities, if there is a rebound of inflation, will repay accordingly. So as interest rate peak, they are much more attractive than nominal bond securities. And finally, definitely, I will look at spending. Fiscal spending is going to be a huge focus going forward, because the reason why we have seen the stock market continuing going up during the last year is because there has been a huge amount of fiscal spending. But at a certain point, that has to stop. It's not sustainable. And if we see states like we had Italy coming out this week with the fiscal budget, it was much higher than was previously forecasted. Well, governments have to start to adjust that. And if it comes as we have aggressive monetary policies, we have quantitative tightening, that means further suffering for markets. So it means that investors should definitely be more defensive and look at quality rather than growth.
All right, Althea, thank you very much for the discussion, and I hope we'll meet again in the future with interesting information. Thank you.
You're very welcome, and looking forward to be back with you.
I conclude this broadcast here. I spoke to Althea Spinozzi from Saxo Bank. To those of you who have been listening to us, we wish you a good start of the week and a profitable trading session.
Știu ce spun.
Marcel Ciolacu și-a prezentat în Parlament și Senat forma finală a reformelor fiscale.
Trăim un moment istoric, nu se mai poate. Am reușit să ne întoarcem în comunism.
Știu ce te interesează.
Pierdem 2% din PIB pentru că nu suntem în Schengen.
Domnule Marcel Ciolacu, și eu m-am săturat să nu fie doar vorbe, să fie și fapte.
Știu cum să te fac curios.
CEO-ul Meta a anunțat lansarea primilor ochelari dotați cu inteligență artificială. Port ochelari ăia șmecher și vin și mă uit către tine și datele tale cine știe pe unde ajung.
Știu cum să te emoționezi.
Zelenski numără și eroi români de-al nostru, Radu Posu. A fost prin tranșee, s-a ascuns de rachete, continuă să ajute Ucraina chiar dacă nu pune pe masă miliarde.
Știu să conving.
Polonia și-a schimbat politica.
Se gândesc să le livreze din nou arme ucrainenilor.
A fost Zelenski care a anunțat că îi dă în judecată. Pentru ce îi dai tu în judecată pe oamenii ăștia care te sprijină?
Știu să câștig.
Ai avut o apărare slabă.
Știu, deci știi.